Every single year, millions of people enter the stock market with hope in their hearts and leave with disappointment in their accounts. They read the headlines, they follow the experts, they chase the trends, they try to time the market, and despite all that effort, more than 90% of investors fail to beat the market. Not because they're unintelligent, not because they're lazy, but because they're playing the wrong game. Today, you'll learn the one stock market strategy that quietly outperforms almost everyone, a strategy backed by decades of data, ignored by the masses, and followed by many of the world's most successful investors. If you stay until the end, you'll understand why doing less in the market often leads to more wealth. 1. The uncomfortable truth about most investors. Let's start with a reality most people don't want to face. The average investor underperforms the market, buys high, sells low, trades too often, reacts emotionally. This isn't opinion, it's data. Multiple studies over decades show that the majority of individual investors and even professional fund managers fail to outperform the market over long periods. In fact, according to long-term performance data, over 80% of actively managed funds underperform the market after fees. Over 90% fail over a 20-year period. This raises an uncomfortable question. If professionals with teams, tools, and insider access can't consistently win, what chance does the average investor really have? The answer lies in understanding the real enemy. 2. The real enemy isn't the market, it's behavior. Most people believe investing is about intelligence. It's not. It's about behavior. The stock market doesn't punish ignorance, it punishes emotion, fear, greed, impatience, overconfidence. These emotions cause investors to panic during crashes, chase hype during booms, overtrade, abandon long-term plans. Ironically, the more people watch the market, the worse they perform. The most successful investors are not the most active, they are the most disciplined. This brings us to the strategy that beats almost everyone. The strategy is simple, but not easy. Buy the market, hold it for the long term, ignore the noise. This is known as long-term, low-cost index investing. Instead of trying to pick winners, you own everything. Instead of predicting the future, you participate in it. Instead of reacting emotionally, you stay systematic. This strategy doesn't look impressive. It doesn't make headlines. It doesn't feel exciting, but it works relentlessly. 4. What index investing really means. An index fund is not a stock. It's a representation of the entire market. Examples: S&P 500 USA, FTSE 100 or FTSE All-Share UK, TSX Composite Canada, global market indices. When you invest in an index fund, you own hundreds or thousands of companies. Risk is spread automatically. You benefit from economic growth. You're no longer betting on one company, you're betting on human progress. And historically, that's a winning bet. 5. The power of averages, why the market wins. Here's something most people don't understand. Individual stocks are risky, but the market as a whole is resilient. Some companies fail, others succeed massively. The index captures the winners and removes the losers over time. This natural selection process means weak companies fall out, strong companies rise, the index evolves. This is why markets recover after crashes. This is why long-term charts trend upward despite chaos. Trying to outsmart this system is incredibly difficult. Joining it is incredibly effective. 6. Why trying to beat the market fails? Most investors try to beat the market by timing entries and exits, picking hot stocks, following analysts, trading frequently. But every trade has costs: fees, taxes, emotional errors. Even being wrong once at the wrong time can destroy years of gains. Research shows missing just a few of the market's best days drastically reduces returns. The biggest gains often happen during periods of fear. Market timers miss these moments. Long-term investors capture them automatically. 7. Fees, the silent wealth killer. Here's a truth rarely discussed. Fees matter more than returns. A difference of just 1 to 2% in fees over decades can reduce final wealth by hundreds of thousands of dollars. Index funds are powerful because they have extremely low fees, minimize unnecessary trading, and maximize retained returns. The wealthy obsess over what they keep, not what they chase. 8. Compounding, the force that does the heavy lifting. Compounding is the real engine behind this strategy. Returns generate returns. Those returns generate more returns. Over time, growth accelerates. But compounding requires time, consistency, and non-interference. The biggest mistake investors make? Interrupting compounding. They panic, they sell, they reset the clock. The market rewards patience, it punishes impatience. 9. Why the strategy feels too simple. People reject index investing because it feels boring. There's no thrill, no story, no bragging rights. But wealth isn't built through excitement, it's built through repetition. Simple strategies often outperform complex ones because they're easier to follow, they reduce mistakes, they require less emotion. Complexity sells, simplicity wins. 10. How the world's best investors really invest. Many legendary investors publicly support this approach. They understand markets are hard to beat, time is powerful, costs matter, discipline beats brilliance. Even those who actively invest often recommend index investing for the majority of people. That should tell you something. 11. The role of market crashes. Market crashes terrify most investors, but for long-term index investors, crashes are temporary, expected, and necessary. Crashes reset valuations. They create future returns. The market doesn't grow despite crashes, it grows because of them. Those who stay invested benefit. Those who flee lock in losses. 12. Why most people still won't follow this strategy. Despite overwhelming evidence, most people won't do this. Why? Because it's boring, because it requires patience, because it doesn't promise quick wins, because it forces emotional discipline. The market rewards behavior most people can't maintain. That's why it works. 13. How to apply this strategy properly. The strategy works best when combined with regular contributions, automatic investing, diversification, and long-term thinking. You don't need perfect timing, you need consistency. Time in the market beats timing the market. 14. What this strategy really offers. This strategy doesn't promise riches overnight, it promises something better: reliability, predictability, and freedom over time. It's not flashy, it's effective. Finally, beating 90% of investors doesn't require genius, it requires humility. The humility to accept you don't need to predict the market, you don't need to beat others, you just need to stay invested. Wealth is not built by outsmarting the market, it's built by staying in it. If this video gave you clarity, subscribe to the Wealth Code, because the smartest move in investing is often the simplest one.